Happy Tuesday, Miles Pitcher from Superior Lending. Hope your day's going great. We've started seeing a lot more action and people looking at homes over the past couple of weeks. I hope your business is picking up. Check out these rates. Here's our chart of the bond market that shows rates have been fabulous lately and are still really, really great. Again, as this chart moves up, rates go down. And so you can see that we're nearing some of our lowest points we've had in a long time on our interest rates. Great time for buyers to be buying. Today I wanted to talk to you about a non-qualified mortgage. Some of you may be familiar with this, others may not. So let's start out first by telling you what a qualified mortgage is. A qualified mortgage is your standard Fannie Mae, Freddie Mac, FHA, VA, USDA loan. It revolves around a rule that's called the ability to repay, or ATR, and it goes through and sets some of the guidelines for debt ratios for the borrowers. Just your standard guidelines. So most of the loans that we do for our borrowers are qualified mortgages or QM loans. There's a growing part of the market that's stepping outside of those, and those are called non-QM loans. I'll give you a few examples of instances where we'd use those and what they are. First is a bank statement loan. Maybe you know, maybe you don't know that we can take a borrower's bank statement for the last 12 or 24 months, and we look at the amount of money they've received in deposits into their account, and we take a percentage of that and we use that as their income in qualifying. This works really well for a self-employed borrower who may have written off a lot of expenses on his taxes, but he still makes great money in his business. Therefore, we look at either personal or business bank statements, calculate his income, and use that to qualify him for the loan. Now, on a non-QM loan, interest rates are higher, and most of the time, they don't carry mortgage insurance. But this is a great way for a client who's self-employed, who writes off a lot of expenses, to get into a home. We do it for a lot of contractors who write off a lot of things, but they still have great cash flow coming in, showing in their deposits. The thing we help them look at is they always ask the question, well, hey, if I show 100,000 in income, I'm going to be paying through the nose in income taxes. We show them, well, that's better, or what we have them look at what's better, paying the income taxes or maybe paying $100, $150 more in their mortgage payment on a non-QM loan because the interest rate's a little bit higher. Generally, we're going to be in the 5 to 7% interest rate on a bank statement non-QM loan. They have lots of different options on them. You can do interest-only versions. You can do 5-year arms, 7-year arms on them, 30-year fixed on those. There's a little flexibility in there. But we've enjoyed doing them. They're great for our clients to be able to get into the home that they want, and then down the road we refinance them out of it once they have the income showing in their tax returns to be able to qualify. Some other examples of other non-QM loans besides the bank statement program that really helps self-employed borrowers is foreign nationals. Many people like using those. Other ones are higher debt ratio people who want to pick up an investment property but need to go higher in their debt ratios. I want you to be aware of this so that as you talk to clients, especially those who are self-employed, this is a great way for them to be able to get into a home, a primary residence, and do it based on their bank statements. Let me know if you have any questions. This is Miles from Superior Lending. Have a great week.